Hello guys, welcome back to my channel. Time and money to have the best experiences out of your life. I'm going to start a series of videos on mutual funds. What is it, how to invest, what are the things to consider, and how to evaluate which are the mutual funds or the funds that you want to invest in. So without any delay, let's delve right into it. So this is the first video, Mutual Fund 101. So let's delve right into it and understand what exactly is mutual fund first. So mutual fund is a type of financial vehicle where different investors pool in money, and this basket of money is then used to invest in various assets like be it stocks, bonds, debt instruments, then real estate, gold, and then various other asset classes. And then this mutual fund is a professionally managed fund, that is many investors and general public like you and I pool in money and invest and give this money to a professional manager, so that it is their full-time job to analyze various companies and think about various scenarios, be it market conditions, then the financial health of the company, then how much to invest and which different asset classes to invest, then which asset to invest, and then invest accordingly in such assets to generate and maximize the return to its investors. So in very simple term, let's assume 5 of you friends came together and contributed how much ever you can and gave it to the person in that group who is smart in financial decision or rather investment decision, and that person will take this money and invest in various asset classes so that you can generate the highest return, with him taking a small percentage of that investment as his return or rather his salary for investing activities. So this in very simple term is kind of mutual fund, but blow this up to large scale and this becomes the mutual funds that we know. So before we delve deeper into other deeper concepts or the things that you should know before you start investing, first of all let's see why mutual fund came into existence and why you should invest. Because there are hundreds of asset classes and thousands of assets in them, it becomes very difficult for a common man to scout and evaluate each and everything and see which is the best return generating asset and then invest in them. It becomes a full-time job, and for many of us a full-time job itself is enough to occupy most of our day, and then allowing time to find as well as using the professional capacity as well as knowledge to actually find and evaluating those businesses or assets to see if they are worthy of investment and worthy of generating returns. It might not be each and everyone's cup of tea. So these professional fund managers came together and launched mutual funds. That is, many small investors can pool in small bits of money so that it can have multiple advantages. First of all, it will help in saving and building discipline of investing. And second is, due to scale of operations, these can be managed little more effectively so that overall expenses incurred in managing these funds come down when you see at each and every level. Third is, you can use expertise, wherein the person who is expert in that field can help you guide and invest your money to generate the best possible return. And fourth, which many people overlook, is exposure and diversification. If you would have invested, let's say with 1000 rupees or 5000 rupees, with big companies probably you could have taken only 1 or 2 shares of each company, or maybe 1 share each of 2 to 3 companies. But with mutual fund you can get exposure to large basket of funds with weightage in different companies in different ratio, and then you will get advantage of diversification and a better return. Now that is done about why mutual fund came into existence, but why should you invest? As a common person, what is your incentive of investing? At the end of the day, each and everyone is taking decisions so that they can have the best experiences out of their life and have a better life altogether. So basically, mutual fund will help you to achieve those long-term goals and even short-term and medium-term goals. It could be for buying that car, buying that house, taking that nice vacation or trip that you always wanted, or be it for your higher education, or be it for any other life goals, including retirement, can be achieved by investing in mutual funds very carefully and systematically and with a thoughtful process. And then because you want to achieve this goal, and for many people it might be difficult to achieve this goal in the current financial state, it becomes imperative to save and invest so that the money that they have grows a lot faster, and it helps them to generate return and income and growth and capital appreciation, which will help them to achieve the dreams that they wanted to have. So again, this point I will cover in the later videos, but I want to highlight in the first video. Most of us might miss that financial discipline to manually invest in each and every month, to actually go and scout for the mutual fund and invest in it. So it is best practice to automate investing and see which are the funds that you can use and invest in, so that automatically those monthly installments keep getting invested, and then it will help you to generate return in long term. So it will help you to something called dollar cost averaging or rupee cost averaging, and this again will be covered in the later videos. This is an introductory video, and this video being mutual fund 101, let's discuss few technicalities that you should know before investing. So first of all, you should note the expense ratio. That is, when you invest in mutual fund, there is something called expense ratio. For managing your fund, the mutual fund professional manager will take some money from you so that he can cover his expenses, be it brokerage expense, be it other legal expense, then the people cost, then the investment cost, etc. is borne, and then some profit that they aim to do will be taken from the money that you are investing. So in general sense, lower the expense ratio, it is better, but this does not always tie up, because maybe some professional manager who has been consistently generating higher return and he has the potential to generate higher return going forward might demand a slightly higher expense ratio for the effort that he is putting in. But again, there is no guarantee that higher expense ratio equals to higher return, but you can think of it accordingly. So basically, to sum it up, expense ratio is the expense that you will incur with the investment that you have made and the money that will outgo from the return that you could have generated. And in this expense ratio only, there is a sneaky way in which agents, those who sell you mutual fund, take away money from you. That is, they might seem they are being a friendly person to you and helping you to invest, but there is commission involved in it. That is, there is something called regular fund and direct fund, and when you invest in regular fund, then some amount of the money that you have invested is given to the agent each and every year, and this money is a commission for the agents who help to bring in money to the mutual fund house. So it's better if you are able to evaluate on basic sense which are the mutual funds that you want to invest. It's better to invest directly through platforms like Coin. Check out my description. I have linked down the description to open your Zerodha account, and you can invest in direct mutual funds without any commissions. Then second point is exit load. That is, some mutual funds have this concept of exit load. That is, if you withdraw your money within 1 year or within 2 years, time stipulated as per the mutual fund house, they are able to charge exit load. To simply say it, let's say you had invested 10,000 rupees and you aim to remove that 10,000 rupees within a year, and if that scheme has 1% exit load, it would mean when you are removing that, let's say it would have remained at 10,000 rupees itself, then 1% of that would be deducted while giving back the money to you. That is 100 rupees in this case. And third concept is tax applicability. That is, both at the time of investment as well as redemption or withdrawal. That is the time when you invest your money, there can be some tax benefit that you can avail. If you are a salaried person and invest in ELSS mutual fund schemes, then you can avail income tax exemption under section 80C for up to 1.5 lakh rupees. So similarly, this benefit can be also availed when you are withdrawing the money. And again, I would like to do a much more deeper video, because tax applicability might vary depending on the type of scheme you are investing in, as well as the amount of money that you are withdrawing and the profit that you make from that withdrawal. And each and every year these tax laws keeps changing, so keep updated and ensure to go through at least few key things that will impact your tax burden. And next is risk. That is, few investments are very risky and categorized as high risk, and there are few funds which are medium to low risk. And again, these technicalities and how it is calculated is being regulated by SEBI, and people have to abide by it. So for you, you can just look at whether it's a high risk, medium or low risk, and according to your investment horizon plus risk capability, you can decide which are the funds that you can invest in and you can bear that risk. And there are few legal things which can be sorted out by the broker that you are opening your account in. Now, when you open an account online, most of the things related to this like KYC and few other things are sorted out by them. So you need not have to break too much of your head, and you just have to go through the documentation and sign and declare things accordingly. And then last but not the least, and rather the most important thing, why you invest in, that is return. That is the money that you have invested in, how much percentage is there a probability for it to grow. And as they declare, or rather disclaimer is given on the mutual fund schemes, that is, past performance is no guarantee for your future returns, but you can look at the investment fund manager and what are the assets they are investing in, and the basic documentation that they mention, and a Google search would help you to understand what is the target goal for this. And then again, few mutual funds might underperform or overperform when compared to its peers, and sometimes it might be, some years it might be ranked higher, some years it might be ranked lower, and you would aim for a higher return generating fund. And there is no standard rule or a benchmark return that you should expect, and depending on your investment type that you want to do. If it's a short and medium term, then it might be difficult to expect a higher return, and if it's a long term, then you can take a little more higher risk and expect to return a higher rate of return. It can go up to 20-30% as well, but these are exceptional cases. But generally it's seen that 12 to 15% in long term horizon can be something that people can expect. So with this, I think this has been a short but sweet video to help you to at least get interested or start thinking about starting to invest in mutual funds. So please ensure to be proactive and check out my link and download and open your account in Coin, and then start investing in mutual fund and look for your long-term horizon and your growth potential. With that, ensure to like the video, subscribe to the channel, as well as comment down below and let me know the thoughts that you are having and any queries you have. Also check out my Telegram channel where you can have a personal discussion and connect with me, as well as share it with as many people as you can, so that many people become aware and become more financially literate and aim to have the best experiences out of their life. I'll see you soon.